Picture this. You wake up tomorrow, walk to your bank, and they just don't have your money. Not because they were robbed, not because of some glitch. They simply lent it all out and hoped you wouldn't ask for it today. Before you close this video thinking that's some dystopian hypothetical, that was literally just a regular Tuesday in 1800s America. Welcome to the story of how the most powerful financial institution on Earth was born out of pure, absolute chaos. And yeah, a secret meeting on a private island. We'll get there. By the end of this, you'll understand the Federal Reserve better than most people who pretend to on the internet. Stay with me. It's the 1800s. The United States is a young country doing young country things. Expanding westward, building railroads, arguing about everything. And the banking system? The Wild West. Literally. There was no single national currency everyone trusted. Individual banks, thousands of them, issued their own banknotes, their own money. A dollar from a bank in New York might not match a dollar from a bank in Ohio. Sometimes notes were worth face value. Sometimes 50 cents on the dollar. Sometimes the bank collapsed on a Wednesday and the notes became wallpaper. And bank runs? Practically a national sport. The Panic of 1819, the Panic of 1837, 1857, 1873, 1893. America was collecting financial panics like Pokemon cards. Every few years, the same cycle. Banks overlend, people get nervous, everyone rushes to withdraw at once. Banks can't pay, they fold, businesses collapse, people lose everything. No safety net, no central authority, just vibes and prayer. Something had to be done. And to be fair, they tried. Alexander Hamilton. Yes, the musical guy. But more importantly, the first Secretary of the Treasury pushed hard for one. In 1791, Congress chartered the first Bank of the United States, stabilize the currency, manage government funds, bring order to the chaos. And honestly, it worked reasonably well. But critics argued it handed too much power to wealthy elites and the federal government. When its charter came up for renewal in 1811, Congress let it die by a single vote. So they tried again. 1816, the second Bank of the United States. Same idea. Once again, it actually helped. But then Andrew Jackson showed up, a man who hated this bank the way some people hate slow Wi-Fi, except with political consequences. He vetoed its recharter in 1832 and went to war with it until it was dead by 1836. After that, America went without a central bank for nearly 80 years. 8 decades of banking with no referee. You can guess how that went. Fast forward to 1907. Another panic, and this one is bad. The stock market drops nearly 50%. Banks are failing everywhere. And here's the wildest part. The person who stops the bleeding isn't the government. It's one man. J.P. Morgan. Morgan, 70 years old, personally gathered the top bankers in New York, locked them in his private library, literally locked the doors, and told them they were going to put up their own money to stabilize the system. And they did. The panic was contained. But the message was impossible to ignore. A modern industrial economy cannot depend on one rich guy happening to feel generous during a crisis. What happens when Morgan dies? What happens when the next rich guy says no? Congress agreed. Something permanent had to be built. And here's where the story gets cinematic. November 1910. A small group of men board a private train car in New Jersey. They use first names only. Some use fake names. Anyone who asks is told they're going duck hunting. They were not going duck hunting. Their destination? Jekyll Island, a private resort off the coast of Georgia owned by some of the wealthiest families in America. And over roughly 10 days, these men drafted the blueprint for what would become the Federal Reserve System. The lineup: Senator Nelson Aldrich, head of the National Monetary Commission; Henry Davidson, senior partner at J.P. Morgan & Company; Paul Warburg, a banker from Kuhn, Loeb & Co., who had studied European central banks extensively; Frank Vanderlip, president of National City Bank, one of the largest in the country; Benjamin Strong, representing J.P. Morgan's Bankers Trust; and A. Piat Andrew, Assistant Secretary of the Treasury. These were not random guys. This was arguably the highest concentration of financial power in America sitting in one room, designing a system in secret. And people have debated the ethics of that secrecy for over a century. What's historically clear is that it was deliberate. They knew that if the public discovered Wall Street bankers were designing the country's monetary system, the whole thing would be politically dead on arrival. Paul Warburg, drawing on his deep knowledge of the German Reichsbank and the Bank of England, was instrumental in shaping the structure. The idea was to create a central institution that could act as a lender of last resort, provide an elastic currency that could expand and contract with the economy, and bring stability, while being decentralized enough to avoid the political opposition that had killed the first two banks. Their initial draft was called the Aldrich Plan. It went through significant revisions. Political battles raged. But on December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act into law. The Federal Reserve was born. Now here's something that catches a lot of people off guard. The name Federal Reserve implies reserves, vaults of gold or mountains of cash backing every dollar. The reality is more nuanced. The Fed operates within a fractional reserve banking system, meaning banks only keep a fraction of deposits on hand and lend the rest out. And in March 2020, the Fed reduced the reserve requirements to 0%. That is not a conspiracy theory. That's published Federal Reserve policy. So does the Federal Reserve sit on a mountain of reserves backing every dollar? No. The system runs on liquidity management, confidence, and the Fed's ability to create money. Yes, essentially from nothing, when it determines the economy needs it. Whether that makes you feel secure or keeps you up at night probably says a lot about your personality. So what does the Fed actually do day by day? Think of it as the economy's thermostat, except the house is 330 million people, and everyone disagrees on the temperature. Congress gave the Fed a dual mandate: promote maximum employment and keep prices stable. In practice, that means constantly balancing two forces: keep enough people working without letting inflation eat everyone's paycheck. Their main lever is the federal funds rate, the interest rate banks charge each other for overnight loans. When the Fed raises it, borrowing gets expensive across the board. Mortgages, car loans, credit cards, business lending, everything tightens. When they lower it, money flows more freely. Mortgages get cheaper, businesses borrow to expand, hiring picks up, and suddenly everyone feels more optimistic about the economy. But if they keep it too low for too long, all that cheap money starts chasing the same goods, and prices creep up, which is how you end up right back at the inflation problem you were trying to avoid. If you've ever wondered why your mortgage rate changed, or why your credit card suddenly got more expensive, this is probably why. That decision was likely made in a room you've never seen by people you didn't vote for, based on data you'll never read. And it hit your wallet anyway. They also buy and sell government securities to influence the money supply, supervise and regulate banks, operate the payment systems that move money across the country, and serve as the lender of last resort, the exact function that was missing during all those 19th century panics. The system is led by a board of governors appointed by the president and confirmed by the Senate, with 12 regional Federal Reserve banks spread across the country. That decentralized structure traces directly back to those Jekyll Island debates about making sure no single city or group held all the power. A century of financial chaos. 2 failed banks. 1 legendary financier locking people in his library. 6 men on a private island. And the institution they built now touches every dollar you earn, borrow, save, or spend. You don't need a finance degree to understand the Fed. You just need the story. Now you've got it. I'll see you in the next one.